look, I'm an optimist. I said there's storm clouds, they're big storm clouds, it's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks that the Fed can handle this. That hurricane is right out there down the road coming our way.
That right there is Jamie Dimon. He's not as well known as Warren Buffett or Charlie Munger or Ray Dalio, but he is a very important figure in the US economy because he is the CEO of JPMorgan Chase, America's biggest bank, and he has been since 2005. So when something happens in the economy, it's fair to say that he hears about it. Usually you don't really hear Jamie Dimon making massive headlines in the news. He pops up occasionally here and there. However, this time he has definitely pricked investors' ears up. And the reason for that, as you just heard, is because he's predicting an economic hurricane. So in this video, I want to explore why Dimon, a man so close to the heart of the US economy, is predicting such a dire situation. As we'll see, his prediction comes down to 3 key factors. So let's see what Jamie has to say, and then at the end, let's talk through some practical steps as to how you can sidestep this storm.
There are 3 things that we're going through, which are, I hate the word unprecedented, which are kind of unprecedented. And you got to put this in the back of your mind when you've seen things that have never happened before. Then you have to question your ability to predict, okay? One is huge growth in this country driven by fiscal and monetary stimulation. That isn't a normal recovery, okay? And that fiscal stimulation is still in the pocketbooks of consumers. They're spending it. They're spending at very strong levels. And the data is completely distorted. It's distorted by inflation. It's distorted by, they went from goods back to services. It's distorted by all these things, but jobs are plentiful. Wages are going up. Consumers are spending, the lower income folks, not quite as much as before, but everybody else, it looks like they have $2 trillion more. Savings rate drop. I don't think that's going to stop the spending in 6 or 9 months.
So that's point number 1. That's kind of the setup. Firstly, for a balloon to burst, you have to blow it up. And that's what Jamie is talking about here. Over the past year or two, we have seen truly massive stimulus by the Federal Reserve. The Fed's balance sheet has grown. It's ballooned from $4 trillion up to almost $9 trillion over the space of like 2 years. And as we know, this put a lot of money in the hands of the government, and they decided to do big stimulus payments for their citizens. Now, I'm not trying to criticize or get political on whether that was the right or wrong thing to do, but what it meant is that all of a sudden you had this big spike in personal savings. So people had more money to spend, and spend it they did. Consumer spending is currently at all-time highs, and as Michael Burry pointed out recently, people's savings balances are dropping. When you couple that with the low interest rates we've seen, so aka consumers and businesses are able to load up on cheap debt, they're able to buy houses or build new factories or open new stores, etc. Well, all of that stuff is inflationary. It encourages spending, it encourages the demand side, and thus it encourages price rises. I'm not criticizing that. After all, this was a tactic by the government and the Federal Reserve to get the US economy back into gear as soon as possible after it was locked down. Have a look at this. In 2020, yes, US GDP fell off a cliff, but it also rebounded equally as fast thanks to the actions of the government and the Fed. Whereas on the flip side, if you look at something like 2008, it was a much more gradual recovery. So I'm not criticizing, but of course, with all this printing and all this spending, plus a messed up global supply chain, you have inflationary pressures on both sides of the equation. Factors increasing demand and reducing supply. And of course, what did we get? A whole lot of inflation. There you go. Economics works. But now with an annual inflation rate of 8.6%, that's simply too high. So the Fed has to take money out of the system to try and cool the demand side as supply catches up.
The Fed has to meet this now with raising rates and QT. And the new part of this isn't the raising rates, it's the QT. The QT we've never had QE before like this. Therefore, we've never had QT like this. So you're looking at something they're going to be writing history books on for 50 years. What was QE? What worked? What didn't work? I think a lot of parts of QE backfired. I think the negative rates was probably a huge mistake for a whole bunch of different reasons I won't bore you with now. But they're going to have to raise rates. And in my view, they have to do QT. They do not have a choice because there's so much liquidity in the system. They have to remove some of the liquidity to stop the speculation, to reduce home prices, stuff like that. And you've never been through QT. So all the major buyers, if you go back to 2010 and say, who are all the major buyers of treasuries? All that time, it was central banks, foreign exchange managers, banks who were topping up their liquidity profiles because we had to for regulations. All three, it won't happen the go round. Banks are topped up. Foreign exchange matters are topped up. The central bank will be selling, not buying. And governments have much more fiscal deficit to finance. That's a huge change in the flow of funds around the world.
I find this take really interesting from Jamie. His opinion is there's so much money in the system that the Fed basically has no choice but to do quantitative tightening. Basically, the exact opposite of what the Fed was doing last year. Last year they were printing money. The government was giving it to people. The Fed kept rates low, so debt was easy to access for consumers and businesses. And that encouraged the spending to dig America out of the economic hole that it was in. Now, they're taking money out of the system. So during the pandemic, the Fed purchased a lot of US Treasury bonds and mortgage-backed securities, but predominantly these government bonds, and now they're getting rid of them. So two ways they can do that. They can either sell them on the open market, or the other thing they can do is simply let the bonds reach their maturity. The government pays back the Fed plus interest, and the bond is finished. Then once the Fed receives the money back, then they basically just do a Donny Azoff from the Wolf of Wall Street and just delete it all. Thus reducing the amount of money in the system. Now, what's interesting at this point in time is that we're just starting to see the beginning of the balance sheet reduction. As Vanguard notes, quote, the Fed plans to reduce its $8.5 trillion balance sheet beginning June the 1st, so just a few weeks ago, when it will no longer reinvest proceeds of up to $30 billion in maturing Treasury securities and up to $17.5 billion in maturing agency mortgage-backed securities per month. Beginning September 1st, those caps will rise to $60 billion and $35 billion respectively for a maximum potential monthly balance sheet roll-off of $95 billion. So it's happening right now and will scale up over the coming months. And the thing that Jamie Dimon is so nervous about is that QT hasn't been done at this scale before. So who knows what's going to happen in the markets? We don't really know what the right amount is to help get inflation back under control, and we also don't know how bad the market reaction will be. In fact, the last time the Fed tried to do just a little bit of QT from October 2017 to July 2019, the market performance was terrible. So much so that the Fed actually decided to stop doing the tightening altogether. So it's not a great case study considering this time around the QT plans are much bigger, and we've already seen the market lose 20% this year. So that's Dimon's second concern.
And the third thing is Ukraine. That you've not had a European land war since 1945. And the complexity of Ukraine is we don't know the outcome. I always make a list, if you predict the outcome. Well, you couldn't predict the outcome of Vietnam, Korea, Afghanistan, Iraq, 10 other conflagrations. All wrong. Wars go bad. They go south, they have unintended consequences. And this happens to be rolling the commodity markets of the world. Wheat, oil, gas, and stuff like that, which in my view will continue. We're not taking the proper actions to protect Europe from what's going to happen in oil in the short run. And we're not taking the proper actions to protect you all, what's going to happen to oil in the next 5 years, which means it almost has to go up the price.
So third point, just to add fuel to the fire, we have Russia's invasion of Ukraine, which, as Jamie noted, is playing havoc with commodity markets around the world and causing a lot of price rises. We've seen energy costs soaring.
Western sanctions against Russian energy giants have resulted in a major gap on world energy markets.
Fuel prices rising.
Gasoline prices hit all-time highs in March 2022.
Halted shipments of grain out of Russia and Ukraine.
Russia's naval blockade of Ukrainian ports has bottled up 20 million tons of grain destined for global markets, threatening to worsen current food shortages.
Here's a stat. Nearly 1/3 of the world's wheat and 1/5 of the world's corn comes from Russia and Ukraine. Think about the ripple effects into food products if we lose literally 30% of the world's wheat and 20% of the world's corn. Already, the conflicts in Ukraine and the disruption to exports has led to food prices skyrocketing in Africa and Asia. And the frustrating thing is that it doesn't look like it's going to end anytime soon. In fact, Jamie Dimon can see a world where oil rises to $150 to $175 per barrel over the medium term, roughly 50% higher than where it is today. Families are already feeling the pinch at the pump. What if things got 50% worse over the next 3 to 5 years? Now, I'm certainly no expert on these commodities, but I do think it's interesting hearing the CEO of JPMorgan Chase speaking with such conviction about these topics. 3 big factors that are stacking on top of one another to cause an economic hurricane in the eyes of Jamie Dimon.
We're not dealing with these challenges. So those 3 things, fiscally induced growth, QT, Ukraine war. So I'm going to change the storm clouds out there because I'm an optimist. I said there's storm clouds, they're big storm clouds. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself. So JPMorgan is bracing ourselves, and we're going to be very conservative in our balance sheet on with all this capital uncertainty. We're going to have to take actions, and I kind of want to shed non-operating deposits again, which we can do in size. To protect ourselves so we could serve clients in bad times. And so that's the environment we're dealing with. And, I think it's okay to hope that'll end up okay. I hope it. That's my Goldilocks. I hope. Who the hell knows?
So fair to say, Jamie paints a pretty bleak picture of where he sees the world heading. So to try and cheer things up at the end of the video, just wanted to take a minute to just discuss what we can do about this situation. How can we stop Jamie's economic hurricane from wiping us out? Well, I think the main way you can protect yourself is just to make sure that you've got your debts under control. So yes, things are getting more expensive, groceries, petrol, etc. But the main thing that will properly screw you over is big interest rate rises on big chunks of debt, like car loans and mortgages. So the number one thing you can do is make sure you've got your debts under control and assess whether you could still service your debts if rates went up literally 2, 3, 4% from here. Because honestly, it is on the cards. So keep those debts under control first thing. But secondly, also do everything you can to make sure your income is secured and not at risk of stopping over the next few years. And on top of that, make sure you have an emergency fund. So if anything bad were to happen over the next little while, you get laid off from your job or something like that happens, then you'll still be able to cover your expenses for like 3 to 6 months. If you can do that, I think that puts you a good chunk of the way from sidestepping this storm. And if you're interested in learning how to sidestep the current macro environment in terms of your stock portfolio, I will leave a link to a video up on the screen right now because I literally just made a video about that last week. So definitely check that out. But with that said, guys, they are Jamie Dimon's thoughts on the economic hurricane headed our way. Let me know what you think. Do you agree with Jamie and think the economy is looking pretty dire? Do you disagree with him and think his rationale is a little bit overblown? Definitely let me know what you think down in the comment section below. But apart from that, guys, leave a like on the video if you did enjoy it, subscribe if you'd like to see more, and I'll see you guys in the next video. This video is brought to you by ShareSite. Sick of tracking your performance manually? Track capital gains, dividends, and currency fluctuations easily, and when it comes to tax time, have everything you need ready to go with just a click of a button. Try ShareSite for free or use the referral link in the description to get 4 months free when you sign up to an annual plan.